Well, last week, stock market volatility picked up a little bit. We've seen global stocks drop. The S&P 500 shed about 1.5% as geopolitical risk or tensions started to rise with North Korea. The VIX, or implied volatility, rose about 55%, and that's really where the opportunity was. Word got out that we made some great money with a specific trade that we had set up actually a couple of weeks ago, and it just finally started paying off. So what I want to do is I'd like to show you guys what we did and how you can do this as well. So to put the things in perspective a little bit, on July 25th, you can see it right here. This is a real-time text alert that I sent out to Clubhouse members. I told people that with the VIX dropping into the low nines, it actually tickled the high eights, I believe, a few days after that. We bought a straddle in the S&P 500, 240 strike October puts and calls. I also said that one could alternatively just close some positions, maybe short the S&P for a trade, buy the SPXF ETF, all that kind of stuff. But the trade I want to show you is what we did with the straddle. Again, directionally it's the same idea, but let me show you what we did. So on that day we bought the 240 strike calls and puts for, you'll see here, for about $4.47 for the call and about $4.42 for the put. Well, on August 11th, which is last Friday, we saw the call deteriorate down to $3.15, and the puts go up in value to $6.60. On net, that gave us about $86 in profit per one-time doings. You did that 10 times, and you make $860, being completely agnostic in which direction the market moves. But in order to see this kind of stuff and to get to the kind of trade, you have to have perspective. Once the market starts to move, it's too late. This is the kind of opportunity that you can only come about if you have a process in place. So let's first start with our sector and group rotation. So what I have is I've developed my proprietary algorithm. It's a scanner that we use also in the clubhouse, and it's available for the public for anyone who wants to purchase it, which allows us to look at near-term trends, medium-term trends, and long-term trends as far as stocks, single-name stocks, and sectors go. So you can see, for example, here, right now, the utilities remain the only sector in the S&P that's near-term bullish. Everything else is either near-term bearish or near-term neutral. Here's the near-term bearish sectors right now. These are the medium-term bullish ones, and then medium-term bearish, and so on down below. So what we've been seeing taking place over the past 2.5 weeks or so is more and more sectors started dropping away from the near-term bullish list into near-term neutral and near-term bearish. And finally, last week, we actually saw the broader market give and volatility spike. So that's a bit of a backdrop of how we start to measure this, because unless you have this perspective, a lot of what you're doing is just going to be guessing, and most people don't want to admit that to you, but that's really the reality. So if you look at the VIX, which represents the implied volatility, as I said before when I sent out that text alert on July 25th to my Clubhouse members, we were very, very low in implied volatility. So it gave us an opportunity to buy puts and calls for a very, very cheap price. So I wasn't trying to make a bet that the stocks were dropping, although I did think that the pressure would be to the downside. But I, particularly with this trade, made the bet that most likely implied volatility is going to at least somewhat increase. And obviously stocks dropped last week, but most importantly for me, implied volatility rose, which actually increased the value of both the puts and the calls. But of course, because the market went down, the calls lost somewhat in value. But the puts gained more in value and the calls lost less in value than they would have, because the implied volatility, which is a part of the options pricing, actually increased. It gave us a profit of about $860 per one-time doings, per one-time buying a put and one-time call. You do it 10 times, you make $86 per one time, $860 per 10 times doing this. So that's a trade that we did. But again, the key thing that I want to point out to you guys is that in order to do this kind of trade, you have to have perspective, not only in terms of how low something like the implied volatility is, but also understanding that what's happening from a sector and group rotation perspective. And unless you have a good tool to measure that, it's very, very difficult to do. In summary, what I'd say is this. There's a lot of different option strategies out there, and I think options are good to use sometimes, not all the times, which is why we use stocks and options and ETFs to our liking. But the important thing is to use the correct strategy at the right time, and that's really the key thing. Also, very important, we still have some tickets left for our Chicago Super Trader Summit. It takes place September 24th to 26th. Going to be an amazing lineup. We got a great guest speaker, whole bunch of speakers of us, including myself included, of course, going to be presenting there. We are going to be going to the one of the trading floors. We have free lunches, free cocktail hours. It's going to be an amazing event, not only from an information perspective. You're going to learn so much stuff from trading and investing, but also from networking perspective. And let's be honest, Chicago in September, it's hard to beat. So hope to see you guys there. Early bird tickets are still available, a few of them. So make sure you grab them in the link down below.